Okay, we are doing personal finance, chapter 15's static problems. This is all about bonds. Bonds have a face. Okay, if you see this rectangle on my spreadsheet, bonds have a face value. Usually their face values are in increments of 1,000. Okay, the bond has a face and an interest rate, which is also known as the contract rate or the coupon rate. Bonds also have a maturity date. Now, I put that all in the rectangle there to represent the fact that a bond, that is the contractual agreement to the bond. So nothing changes on the bond itself. But there is a market rate of interest that does fluctuate with whatever's going on in the economy. So we will be comparing once in a while our coupon rate to what's going on in the market to see if our bond is valuable or not so valuable. So the price of a bond is dictated by actually the fluctuation of the market rate interest. Okay, so this first one is talking about $1,000 corporate bond that can be convertible to 40 shares of the firm's common stock. So what price must the common stock reach before investors would consider converting their bond to common stock? This is taking a debt instrument, which has interest that must be paid back, and converting it into ownership or shares of stock of this company's business. So this is Wallace Electronics. So if you take 40 shares, $1,000 divided by 40 shares, they would become interested in the conversion if the stock price got to 25 or more. Okay, so that's what number one is about. 25 or more, okay, is how much you want. Number two just simply calculates that coupon rate or contract rate of interest that's on the bond. Remember, interest rates are always stated annually unless otherwise noted. So you would simply just take, if this was a bond that had a face value of 1,000, over here in my spreadsheet, I've got $1,000 face with a 4.9% annual interest rate. And then if you converted that into two semi-annual interest rates, it's simply just half. So the first one is $49 is paid to the bondholder, or two payments of $24.50. Okay, it just depends on the contract of the bond, how often they pay interest. I've never heard of anything. There might be quarterly interest, but monthly interest would get to be pretty time consuming to pay that, right? Okay, the next one is just 5.4%. 5.4% times 1,000 ends up being $54 in annual interest and $27 in semi-annual interest. 6.8% on, and that is not what I wanted there. 6.8% interest is, okay, I lost my train of thought. $68 of annual interest with 34 semi-annual interest. And then the last one is $1,000 bond with a contract rate of 3.8% interest. You say, why do you take all of these times one? Once again, you always have the time factor in there, even if it is just once a year, right? Actually, to get semi-annual interest, you would take it times 1/2, right? Or 1/2. So if you were looking at it that way. All right, on to number 3 now. Now we're going to do the present value. The present value of a bond calculator. Use the present value of a bond calculator at bond price calculator. So that is a bond price calculator out on the internet. Approximate the present value for the following $1,000 bonds. Okay, so here is number 3. Let me see if I can go out here to the bond price calculator, but I also want this. So here's what I'm going to do. I'm going to snip this just so I don't lose it or lose being able to see it. All right, so I've got that in my snip. All right, and now I'm going to Okay, so this is a bond price calculator, right? Bond price calculator. So we've got to put things in to this. So here's what's on the bond, $1,000 face. So let's put $1,000 in. Okay, the coupon rate. Okay, the coupon rate for our problem. Okay, here it is. The first one is 6%, 10 years to maturity. The frequency of payments is semi-annual, and the market rate of interest is only 5%. So I can tell you right now, our coupon rate is more attractive than what's in the market. If we know that, the bond will sell at what? More than its face. Yep. So let's put the coupon rate in. The coupon rate is 6%. So let me put that over here in the rectangle. It pays semi-annual interest, and the years to maturity are 10%. The market rate is 5. Okay, so I've put all these factors down. It will sell at a premium because our coupon rate is 6% and the market rate is only 5. Okay, so if that helps you see the picture better.
Incoming call.
No.
16.
No. Well, okay. So once again, our coupon rate is 6%, our market rate is 5%. So let's put 6% in. The compounding frequency is semi-annual. The market rate of interest is 5%, and it's 10 years to maturity. And if you calculate, here comes a bond price. Okay, here comes a bond price. So in green, I'm just simply going to fill in from the calculator what it says. And we knew it was going to sell at a premium. We knew it was going to be more than its face. So at least that's reassuring that we got the right answer. Okay. Now I'm going to go out here and calculate all these and then put them in. All right. Okay. So the next one then is, coupon rate is 5.4%. So let me put that in my spreadsheet here. Okay. We're looking for the bond prices of all of these. So I'm going to take out what is in my green. Okay. My next one is a coupon rate is 5.4%. 5.4%. We want to know its maturity date is in 8 years. The market rate of interest is 6.4. Okay, so therefore, it will sell at a discount because the market rate of interest is higher, right? Other investors can make 6.4% on another kind of investment when ours is only paying 5.4. Okay, so when the coupon rate is smaller than the market rate, it will sell at a discount. So here is proving that. Okay, back to the bond calculator. Let's reset it. Okay, if you reset it, it resets all of your variables. So the face for all of these are 1,000. The coupon rate or the contract rate is 5.4%, and this one pays annually. All right, so we do need to put that in. And that's the compounding, and that's what it is automatically. The market rate of interest is 6.4, and the maturity in years is 8. So here comes the bond price. Is it less than the face? Yes. So there's always a good feeling that you already knew that if you understand the rates and how they affect a bond price. So once again, this one sold at a premium. This is going to sell at a discount. So now let's look at the third one. Okay, the third one. So it is 6.2. 6.62 is the contract rate. 6.62. Okay. And its maturity date is 6 years into the future. This is going to be, and the market rate is 5%. Okay, this is going to sell at what? If our contract rate is pays better than the interest in the market, what's our bond going to sell for? Anybody? It's going to sell for a premium. Yep. So I got to fix what this says. Sell at a premium. Sell at premium. And you can always show this. Okay, once again, our bond has 6.62, but the market only has 5. So, yep, bond is going to sell at a premium. Okay, so I'm going to borrow this here. And all right, so now we're going to expect a price of more than its face. Okay, so pull that back up and put in what we have here. $1,000 coupon rate is 6.62. It pays semi-annually. Yep. And market rate is 5%, and we're looking at 6 years to maturity. So here we go. So, yep, it is selling for more than its face. So there you go. Now I'm going to put all these in and see how I did. Okay, so once again, approximate present value, approximate. So something close to it, right? But we do know which direction the price will go because we know the contract rate and the market rate. Once again, when the contract rate on a bond and the market rate are the same, it sells at its face. And they didn't have you sell it at its face for this one. Okay, so just keep that in mind though. All right, so last one. Let's see, pray, hope and pray we got it. Okay. Anybody have any questions about that? When you put all your information down, I think it's pretty straightforward. You know, so you just got to get those terms, vocabulary terms about bonds kind of under your belt. Okay, number 4. All right, let's talk about purchasing a bond, right? You can purchase a bond just like you would a share of stock, right? A bond has a price. If you want to pay the price, then that's what you pay to get it. So Sharon Blackstone purchased $1,000 corporate bond. How much did she buy it for? 910. She's buying it at a discount, right? It's less than its face. The bond pays 6%, right? The market is going to pay more than that. How do we know? Because it's selling at less than the face. 4 years later, she sold the bond for how much? $9.85. So a little more than she bought it for. Calculate the total return. Okay, let's put this down now. So just like anything else you would calculate, you're going to put the sales price down. Okay, the sales price. So the sales price of this bond was $910. I'm sorry, the purchase of the bond. When she first bought the bond, she bought it for $910. The face was $1,000. The coupon contract rate is 6%. Okay. And they didn't tell us how long the bond will be, what the maturity date is. So I'm going to take that out because I don't know what it is. Okay. I don't know, but some bonds can last 30 or 40 years. Yep. Like your revenue bonds or your municipal bonds. Okay. What you need to do then is to calculate how much, okay, how much the interest will be every year, okay? The interest that's paid is dictated by the contract rate, okay? So it's going to be 1,000 times 6% every year, and she held on to that bond for 4 years, right? So we are going to calculate the interest, and we're going to calculate the profit or the gain when she sold that bond. All right, so every year she held it. Okay, so 1,000 times, right? 60. So she should have gotten $60 each year for those 4 years, right? Yep. Because the contract rate is the rate that will be used to figure out the interest payment. And this is an annual payment, I think. Yeah, pays annually. Annual payment. So that's also when it compounds. Annual payments. And then I needed to change this, isn't it right? Okay. So she received $60 for 4 years in a row. So there's the interest, the profit. Okay, so then she sold it for $9.85. So she had a profit of $75. When you add the profit of $75 to the total interest, the total return on this corporate bond over those 4 years in dollars is $315. Okay, so buying that bond for $910, she received $60 a year in interest payments that came in, right? So if this was sitting in an account, let's pretend like this bond is sitting in an account, right? It's worth $910. Then she got the $60 4 years in a row, and then she received an extra $75 of profit. So you add the profit of selling the bond and all the interest payments together, and that's the total return. Okay, total return. Any questions about that? Okay. Okay, number 5. Number 5. Where am I at? Oh, here I am. Okay. Number 5. This is actually number 4. There. All right. Same thing. John Nelson purchased a $1,000 bond 4 years ago. He bought it at a premium price, right? A premium price, which is more than its face, of $1,020. $1,020. Okay, so okay, it says the bond pays 3.8% interest annually. So 1 payment a year. Okay, and I'm going to put annual payments. All right, and then 4 years later, he sells the bond for $980. Okay, so he bought it for $1,020, held on to it for 4 years. Here's how you would calculate the 4 years worth of interest. Okay, the 4 years worth of interest. You can do this all in one calculation here. It's 1,000 times 38, or 3.8% times 4. Okay, so 3.8. For 4 years. Okay, so there's the interest and the loss. Okay, so now let me calculate this. So 3.38 times 4. Okay, so it looks like over those 4 years, he had interest of 152. Well, those interest payments offset the loss that he ended up having on buying the bond and selling it, right? He bought the bond for 1,020, but he sold the bond. Here I am. He bought the bond for 1,020. He sold it for 980 4 years ago. So he ended up having a loss on the sale of the bond. However, holding on to that bond for 4 years, he ended up having $152 worth of interest income. And the difference between the two, right? You add these two together. So unfortunately, the loss here offsets a little bit of this interest, but he still has a positive return, right? But just not as big as it could have been. So I got a total return of $112. In total return is always in dollars. Okay, that was number 5. Number 6. Okay, there are different types of debt instruments. So this is what they call a T-bill. Okay. I believe they call it a bill because a bond tends to be a longer term investment. When does this expire? When does the bond mature? 52 weeks. See how it's in weeks and not months or years? So try to use the time and increment that they give you. So we purchased a 52-week $1,000 T-bill issued by the US Treasury. Now, supposedly that is the least risky investment you could ever make. Everybody got that? You could go buy a bond from our government, and hopefully our government will hold its credibility, right? So what's going to happen here is when you buy this T-bill at $955, 52 weeks from now, you can go cash it in for what? The full $1,000. So the difference is what? $45, right? So that $45 represents the interest that the government will pay you if you hold on to it for 52 weeks, right? You say, well, why wouldn't you hold on to it for 52 weeks? Well, maybe something bad happened and you needed to sell the bond, and you needed to liquidate the bond and cash it in or something. So you would want to try. So the discount amount, okay, so let's put it down here. $1,000 bill, $1,000 T-bill. We bought it for $955. So there's $45 to be made over this 52-week period. Okay. When they talk bonds, the bond world likes to use the term yield, like you would yield to get on a highway. Yield. Well, this yield represents the return. Okay. The return or the money on top of what you have invested, right? So the amount of the discount is the difference between the price that was paid and the face of the bill. Okay, the face of the bill. Okay, it says current yield formula. We're going to put the discount in as $45, and then we're going to divide by the purchase price of the T-bill. Okay, so once again, it's $45 to be made. We invested $955 to make that $45. So we need to calculate that here. So we're going to take, oh, by the way, the mature value is $1,000. The maturity value is $1,000. We buy this on January 1 for $955. We hold it until 52 weeks have passed, and then that bond has matured, and then we can go to and cash it in for our full $1,000. Okay, you say, well, that was only 45 bucks. Big whoop. Well, here's how much that yield is. Yield. So if you have 45 divided by 955, you have a yield of 5%. Okay, I'm going to change that to 5%. Okay, so the current yield should be 5%. And let me make sure that, yeah, it divides evenly. Sometimes they don't. See, hey, here's the yield. How many decimal places? 2. So you do have to extend it out it didn't divide in it cleanly, right? So 4.71, let me just take that on out to see what else. Okay, all right. So I believe we're looking at 4.71%. Okay, so 4.71% is the current yield of that 52-week T-bill. Okay. And if you ever buy, does anybody have a family member that bought them a savings bond for Christmas or something like that? That used to be kind of a big deal, but I don't think it's happening today. I think kids would just go, what do I need a savings bond for? No kidding. So kind of like socks. All right. So 4.71%, if my calculations are correct. Let's check it. So that current yield amount would be another way to say that in stock market world is what's the rate of return, right? How much is that bond yielding? It's yielding 4.71%. We now have 4.71% more money than we did, right? So you always have to go by the amount you invest. That's the kicker for the denominator or figuring that out. Number 7, where are we at? Okay. More bonds. William purchased a 30-year US Treasury bond 6 years ago for $1,000. Okay, I'm going to start putting down what's on the bond. The bond pays 3.96% coupon rate. And later he sold it for $1,020. All right. So here's the bond he bought. The bond pays 3.96% interest. It's a 30-year maturity. I want to calculate the annual interest, right? The annual interest. And what did this 3 point? See, it's rounding my percentage. I need to make it. There we go. So now I am going to calculate how much annual interest I'm going to receive. So times 0.0396. Okay, there's the formula. And now let me put it in here. Okay, so 1,000 times 0.0396 times, and he had this for 6 years. Oh, no, I'm just calculating the annual interest times 1. So it's paying $39.6 annual interest, which I think is your first question there. $39.6 each year. And then, okay, he did this for how many years? 6 years. Okay, so now we want to take that annual amount times 6 years. Okay, so we're going to take $39.60 times 6. Okay, to know how much interest he collected or accumulated over those 6 years. Okay, so we're total interest then is $237.60. Okay, and that was 6 times the 39.60, so $237.60. Now let's talk about the sale of the bond. He bought the bond at its face. I'm going to put purchased at face value. Okay. 6 years later, he sold it for $1,020. 6 years later, I'll put all my facts in here. So he made $20 on the sale as a profit on the bond, and we want to include the total interest, right? That was 6 years times the 39.60. So I'm going to put 6 years in here. Okay. And so the total return Total return when you add up the profit from the sale of the bond and his total interest was $257.60. Okay. Now, just in case they would have added, what is the current yield? What is the current yield of the bond? Okay, just for fun. Okay, we'll look that up. So the current yield would be the profit that he made, right? Which is the total return, $257.60 divided by the $1,000 investment that he made, right? So let's see what he's got going on here. So we've got the return divided by the purchase. He's got a bond that's paying or yielding, is another way to say it, yielding 25.76%. If you had a bond out there that was paying that kind of money, I think you could sell it pretty easily. So, yep. Okay, number 8. Here comes another T-bill. Once again, a T-bill. Government bills and bonds. This is something you might want to know. One of the least risky investments you can make with your money, sorry about that, anything from the government. This should be a very, not risk-free, there's nothing risk-free, but should be a relatively low-risk investment. What happens when things are not so risky? You don't get as much of a payout. The riskier something is, the more money there's to be made, right? The opposite is true though. The more risky something is, the more money that can be lost. But government bills and bonds are always sold at a discount, always. So you're going to pay a discount for anything from the federal government or state government, whatever you're buying from. And then when the maturity date happens, you can go cash it in for its face. All right. So calculate the purchase price of a 52-week $1,000 treasury bill with a stated interest of 4.9%. So once again, we're looking at $1,000 face of this bill, right? And it pays 4.9%, just like like I said, you can treat a bill like a bond. It's usually just a shorter time span. Bills, I think, are almost always in weeks. So 4.90. So we want to take $1,000 times 4.90, and that's how much we will subtract from the $1,000. Okay, $1,000. So now let's take that times the 0.049. So $49 discount, right? If we take $1,000 and subtract $49, then the price of the T-bill will be $951. Okay, $951 is how much the T-bill will cost. And then 52 weeks later, that person can go cash it in because it's mature for $1,000. So 52 weeks, we made $49. Yep. You say that's not very much. Well, if you have a lot of those, it could be. Okay. So now remember, bonds do not have the, okay, if you think of stocks like a sprinter, okay, think of stocks like a sprinter. You think of bonds like a marathon runner, right? If you kind of look at it that way, the sprinters are flashy and quick and fun to watch. And they go up and they go down, right? But bonds are kind of just in it for the marathon, right? So that's kind of one way to look at it. All right. Okay, number 9. Now here comes a little bit of tax stuff. Yep, a little bit of tax stuff. So one of the appeals to a municipal bond, like a municipal bond might be something you're going to build in a city. I think El Dorado's had some municipal bonds. the attraction to investing in a government bond or a municipal bond is oftentimes what you earn on them is tax free. Okay, you don't have to pay taxes on any kind of return. So what's happening here? Assume you are in the 37% tax bracket. By the way, does anybody remember that that's the top tax bracket? Last I knew, you're making a lot of money a year. We could go look up what it is. I don't think there's one above that, but I could be wrong. And it may have changed because it changes frequently. And all right, so we're in the 37% tax bracket and we purchase a 3.1% tax exempt municipal bond. The bond itself is paying 3.1%, but you don't pay taxes on that interest. The other bonds that we've been doing interest, you have to include those interest amounts on in your income. And there's a potential for you to be taxed on them if the calculations come out right. But these municipal bonds often are tax exempt, which makes them more in demand from the public. All right, so let's see, 37% tax bracket. The bond is paying 3.1%, 3.1%. Okay, so taxable equivalent yield. Okay, what you do is you take your tax exempt return, okay, tax exempt return. Okay, the tax exempt return is your percentage that is on the bond. You then divide by 1 minus your tax rate. Okay, so let me see if I can show you a problem here that this is how it would work. So our bond is paying 3.1%. Okay, 3.1%. We're in the 37% tax bracket. So the denominator is 1 minus 37%. Okay, and so we're going to calculate this. So you take 3.1 divided by, okay, so 1 minus 37, right? Is what, 63? I think so. Yes. So then you would actually divide by 63%. Okay, so 0.63. No, that's not what I want. Sorry about that. Okay, leave it in percentages. Leave it in percentages. So I'm actually going to calculate 1 minus 37%. 37%. See if it'll calculate for me. Nope. Okay. Let me see here. So we want 1 minus 30. Okay, hang on. 0.37. Okay, why is that? Okay, let me go back where I had it. I had it nice and neat when I had the last one in here. Okay. Oh, okay. So here's what you do. Leave it all in percentages. In fact, I'm going to put leave in percentages. Leave all numbers in percentages. Leave all numbers in percentages. Okay, so you're just going to take 3.1 divided by 63. Okay, so here's what it is. 3.1 divided by 63. All right, and this tax equivalent yield is always going to be higher. Okay, it's going to be higher because what you're doing is you're adding the amount that you get to that you aren't going to be taxed. And I know that sounds weird, but if you'll just kind of keep this formula in mind, once again, we did it in percentages and we leave them in percentages. So 3.1% divided by 65. And I just did it. Here's how else I did it. Okay, I just put 3.1 divided by, so let me put this in here. 3.1 divided by 63. That's how it's going to look if you don't put it in percentages, but you still get the same answer. And you get the same answer. And when you get taxable equivalent yield, that's putting the tax implications into that tax exempt status. So not only is this worth 3.1%, but it's really worth 4.92% because you don't have to pay income tax on it. And that's what it's telling you. All right, let's go to number 10. I think this is pretty much just like what we did. So now this time in number 10, we're dealing with a 24% tax bracket. Okay, our municipal bond that is tax exempt is paying 3.8%. Okay, so we're going to use that same formula. Now we're going to take 3.8%, 1 minus 24%. Okay, so that becomes 3.8% divided by 66%, right? I got to do my math here. 76%, my fault, 76%. Okay, divided by 76%. So 3.8 divided by 76. So that's a 5% tax equivalent yield. So your tax equivalent yield is always going to be larger than your interest on there, because once again, you don't have to pay taxes on it. There's no federal income tax on a tax exempt bond. Okay, everybody got that? Did I miss something? No? Okay. All right, let's talk about when bonds are quoted. So I want to buy a bond. Well, okay, what is the bond's price? Well, it's quoted at 88. What's that mean? Well, that means that the quote of the bond, the price quote of the bond is 88% of the face, right? So 88% of this face is $880. Okay, so whenever they quote a bond at its current price, they'll say this bond is selling at 88. This bond is selling at 90. This bond is selling for 102. So that's above the face, right? So whatever this number is, this is the percentage of the face that the bond's face is. So let's put this in here. So if you have $1,000 bond times 88%, right? Then the price will be 1,000 times 88%, which is $880. Okay, so that particular bond is selling at a discount. The other thing you can figure out is if a bond is selling at a discount, remember the coupon rate is actually, or the market rate is actually bigger than the coupon rate. Okay, because the market is, so it sells at a discount. Okay, selling at a discount is below the face. Sells at discount below face. Okay, if you got to go ahead. All right. The rest of these I think are pretty easy. It's the bond face, current yield. So I'm going to go ahead and keep rolling with my video here. Thank you. Thanks for coming in. We'll see you on Thursday. And remember, I did push back the due date. Okay. So try to get as much of that done as you can. All right, I think this should be right. Yes. Okay, if you want to stick around, I'll finish up. If you don't want to, that's okay too. Okay. Calculate the interest and the current yield for the following $1,000 bonds. So Okay, the first bond pays 6.2%. Okay, so that's going to be $62 of interest. Okay, 6.2. And then the current market value is $1,050. So then you just take the interest amount and you divide by the current market, which is the $1,050. Okay, and so the interest amount divided by the current market. Okay. Oh, I think I just put that in. All right. So then this becomes $62 divided by 1,050. So, all right. Okay. So the current yield equals. Oop. Have a good one. Current yield is 5.9. All right. So, yep. Well, I think we got it. Hope. Yep. Okay. The second one is a bond that's paying 4.5 on its contract rate, which turns out to be $45 of interest a year. Okay, and then the current market price of the bond is $970. So then we want $45 divided by $970. And then the current yield is equals $45. Nope. Yep. Divided by the current market price. Oops. Yes. Okay, so 4.64 is the current yield. All right, so one more time. We're going to go back and put in $45 is the annual interest amount. But then we divide it by the market value, how much it's selling in the market. And it turns out to be, and they want it to 2 decimal places. Okay. Then this one is 3.8. Okay. And that makes it $38 interest. And then the current market value is $1,050. So then you take that $38 and divide it by, $1,030. Sorry about that. 38 divided by 1,030. So the current yield of this last one is 38 divided by 1,030. Okay, 3.69. Not too bad. Okay, number 13. Okay, this is actually a formula. Okay, this is actually a calculated formula. It's called times interest earns. You're going to calculate it. There's a formula for it. And I have it here in the spreadsheet. It's the formula times interest earned. And I'm going to put the word formula equals. Okay, so formula. Okay, it is your income divided by your interest expense. All right, so assume Perfection Homes has operating income before interest and taxes of $512 million. So I'm going to put that in here. Okay, the interest expense they have is $84 million. Okay, and you put this in as just a regular number. You don't put it in as a percentage for whatever reasons. It's not a percentage. just the whole number, right? So not a percentage, use whole number. Okay, so, all right, number 14, two more and we're done. So number 14, $1,000 bond again, we bought for $910. Okay, so I'm going to put that in here. The annual interest, the coupon rate or the contract rate is 4.8%. So that means that the annual interest is $1,000 times 0.048. So it's $48. So then we're going to calculate the current yield, and then we're going to calculate the yield to maturity. All right, so hang on a minute. Okay, we've got $48 divided by the bond price of $310. So then the current yield equals 48 divided by 910. So 5.27. Okay, you need the current yield to get to this yield to maturity. Okay, so here is the yield to maturity formula. Okay, it's got a formula here, yield to maturity formula. We take the annual interest amount plus the face value of the bond minus the market value divided by the period of time. Okay, and it matures in 4 years. So I will put that over here to the side because we need to know that matures in 4 years. So we haven't messed with that yet. Okay, so here we go. Our annual interest is 48. So I'm going to put $48 in, and then the face is 1,000, but we paid $910, and then we're going to divide by 4 years instead of, all right, and that is your numerator, right? So this is going to be a division problem, and I'm going to put a line between these two numbers to represent that this is the numerator and this is the denominator, right? And then down below, we'll put 1,000 plus the purchase price of the bond divided by 2. Okay, divided by 2. So here is what's going to happen. So I'm going to put 48. And this is the actual calculation now. Then I'm going to take in the middle, this takes 3 sets of parentheses. Yep. 1,000 minus $910 divided by 4 years. And then we're going to add 48. Remember, you work everything in the parentheses first. So that's $750. So then here comes the numerator, 1,000 minus $910 divided by 2. Okay, so we need these two numbers, and then we use them. So we take $70.50 divided by $955, and we get a current yield to maturity of 7.38%. So this is all a formula. And the 2 is part of the formula. It's not something that you have to find. Okay, so once again, I put in the 48 and I put in the 910 and I put in the 4 years, but the 2 is part of the formula. Okay, so it's just like what this says. And I believe we've got 7.38. So one is a current yield, so that's paying you yearly, but the yield for the 4 years, because of compounding interest, goes up to 7.38%. Okay, I think that's right. Hope so. Yay. All right, last one. Number 15. Let's do this again. So assume you purchased a high yield corporate bond with a face amount of 1,000. Okay, so I know some of you may have stopped. I'm going to finish this out so I can do the video. Okay, $1,000 face on the bond. We paid $1,030, so we paid a premium. It pays 7% and will mature in 8 years. Okay, so let's put down the amount that we meet, and I put matures in 8 years. We do need to include that piece, all right, and it is paying 7%. Okay, so the annual interest is $70. Oops. Yep, and the purchase price was $1,030. So then we're going to find current yield. The current yield is $70 divided by the price that we paid for the bond. Okay, the $1,030. And now let's do the math here. So we got $70 divided by 130. Ooh, hang on. Whoops. Divided by 1,030. There we go. 6.8% is the current yield. 6.8%. Okay, now we're going to do yield to maturity. Okay, the annual interest payment. That's the $70. And we take 1,000 minus the price of 1,030, and we're going to divide by 8 years. Okay, so there it is. Let's go ahead and keep going here. So then 1,000 plus. Now notice this one's plus. Okay, plus. So we're going to put 1,030 here. Going to add those two together and divide by 2. So this becomes, all right, this is $70 plus 1,000 minus 1,030 divided by 8. Okay, that's 66.25. And then we take 1,000, which is the face, plus the price we paid. We add those two together and divide by 2, and you get 6.53. Now, here is the difference. The one we did before was a bond we bought at a discount. This time we're buying it at a premium. So when you buy it at a premium, your yield to market value, yield to maturity value, or yield to maturity percentage is going to be lower. Okay, it's going to be lower. The reason is you bought it above its face. Okay, you bought it above its face. So 6.53. So a little smaller yield to maturity than the current yield. Back here, one more time, back here, when we did it, our interest rate was 4.8%, and we bought that bond at a discount. When you buy a bond at a discount with a current yield, then the yield to maturity will be larger than the current yield, but the opposite is true. So if you buy a bond at a premium, the current yield should be bigger than the yield to maturity. Okay, hang on. Where did I get that? Hold on. I'm looking. So, 7%. Oh, current yield. All right. Okay. And up here, I guess I was trying to see where this 6.53 came from. Return to question. There's the current yield. Okay. Not just 6%. It is this divided by, I know, I think I've already done this, but I forgot to put it in. Now I want to make this, because they said 2 decimal places. There we have it. Okay, that's it. That's it for chapter 15. I will stop the share and say goodbye. We'll see you on the next video. Have a good one.